Hello, my name is Lucy Haddow. I'm a product specialist for the Baillie Gifford Managed Fund. In a very difficult period for performance, we've put this brief film together to give you the opportunity to hear from one of the fund's co-managers, Stephen Hay. Welcome, Stephen.
Hi, Lucy.
You and I both know very well that it's been a torrid time for investors in the Baillie Gifford Managed Fund over the past 12 months or so. The fund is down around 28% to the end of June 2022. Can you talk a little bit about what's been going on and what's driven the extent of underperformance that we've seen?
Yeah, well, as you say, Lucy, it's been a really difficult time for our investors, especially the newest investors in the fund. Very volatile markets have been very difficult. We've actually seen more than a complete reversal of the outperformance we saw for the previous 12 months. It's been really volatile. What's been going on? Well, clearly there's been inflation, a resurgence of inflation. That's led to expectations of interest rates going up. That means the market is discounting future profits of companies by more. The types of companies that we invest in, the growth companies, which often have their profits further out into the future because they've got great growth prospects, they've been hit the toughest, hardest in the market. So the likes of Zalando, Shopify, Trade Desk, etc., where prices are often down 70 to 80%. And what's interesting though is that actually operationally, these companies are doing well. So across the portfolio, this is not a case of our companies performing badly and therefore being hurt by the market. It's very much been a sentiment shift driven by this change in inflation and interest rate outlook, which has hit often indiscriminately across many of the growth companies that we hold.
So there's a huge amount going on, not just in markets, but in the world more broadly. How do you and the team even begin to think about that in the context of the holdings in the managed fund? What are you doing in reaction to this very different environment that we find ourselves in?
Well, the first answer is that we're really sticking to our investment philosophy and process. There's no change there, no change in the team that's carrying out this task. So we're really just sticking to our investment task. And of course, that's important. That's reviewing the investment cases, so reviewing all our holdings. Thankfully, we're able to get out and about now post-COVID and go and see these companies, go and meet the management and challenge those investment cases. So that's really important. For example, within the European portfolio, we've certain companies that have been hurt in share price terms, we've been adding to because we've reviewed the cases and we think they're really strong from here, so adding to those. But there are some companies where the investment cases haven't been working out quite as well as we would expected. So we've been thinking hard about those, the likes of Netflix and Peloton. So meeting the management, challenging the management, reviewing it internally and seeing where we think the growth prospects are from here. And then there's also the cases that haven't worked out. So every quarter there are some investment cases which don't work out, and we should expect that. And the last quarter or two have been no different. So for example, Vroom, the online used car business in the US, we looked at it again, we reviewed it, and we decided that the balance sheet risks actually overwhelmed the opportunity for a return from here, and so we exited that position. And then on asset allocation, people will know that we don't move hugely in terms of asset allocation. It's very much bottom up led. But what's interesting perhaps is that a year or two ago we had cash in up to 10% of fund because we felt the opportunities to spend that cash weren't that great given valuations. Now that cash has come right down to about 2% in the fund, which really reflects the fact that we're seeing the appetite from all our underlying managers to invest that cash, be it in equities or even in bonds, where the move up in yields has made the investment case for bonds more attractive from here. So that although, as usual with Baillie Gifford, we're patient and we're not changing lots of things, we are not sitting on our hands doing nothing. We are still concentrating on the investment task at hand.
Well, hopefully our investors find that very reassuring. One of the questions that I get a lot, and I'm sure you do too, is in terms of the outlook from here. What is the decade ahead going to look like for growth investors? And ultimately, why should clients remain confident in what we're doing, in our ability to deliver capital growth over long-term periods?
Well, Lucy, we know the next 10 years will be quite different from the last 10 years. We know that. But the managed fund has been going for 35 years now. It's seen lots of different cycles and market crises, etc. So concentrating on finding growth companies is the key to investment success. Now, what that growth looks like may be different in the future than what it's in the past. So although we've had a heavy tech bias in the portfolio for quite some time, that may be different going forward as we look for those growth companies. But importantly, we are finding new ideas. We're not got our head in the sand just looking at existing holdings. We are getting out and about and finding new exciting ideas from the likes of Ocado, which is the grocery online distribution business. Great technology, able to license that globally. We think it's very exciting opportunity. And then Roblox, which is, I know well from my 8-year-old twins who play Roblox games. It's a gaming company. We've followed it since IPO. We're now convinced that the ability to move the gaming into older age segments is there, and that will help with the monetization. So that's another really exciting idea that's come into the portfolio. But overall, I would say, look, it's been a difficult period. We have had difficult periods before. In the long run, concentrating on finding great growth companies is the important thing. And as my colleague, co-manager Ian would say, stick to our knitting. That's what we need to do. Don't get too distracted by short-term market noise, but concentrate on the company's operational performance and the growth prospects from here.
Thanks, Stephen. And thank you very much for watching. And of course, for your ongoing support of the Baillie Gifford Managed Fund.